All right, I am back, and today we're going to be checking out Crown Castle Inc., ticker symbol CCI, and let's go ahead and jump into the 5-year chart. We can see it is pretty much at 5-year lows. It might be a little bit higher. Let's see. Let's try to get the bomb there. It is up a whopping 0.3% from the 5-year low, it looks like. So this one has been getting absolutely destroyed. It's got a dividend yield of about 6.03% right now. This is a REIT, and they are specializing in basically telecom and data transport infrastructure. So cell towers, 120,000 on air or under contract small cell nodes, 85,000 miles of fiber. So basically, you're looking at data transport infrastructure right now for CCI. The competitor would be AMT, American Tower, and that is probably a higher quality player, but we're going to look at CCI and see what we can come up with. So let's go ahead and jump into the investor presentation. All right, so here we have the investor presentation from August 2023. So it is fresh, it is new. Here we can see kind of the overview of their towers, small cells, and routed fiber. And so pretty heavy concentration into the East Coast, some West Coast assets, and then some central, probably just in the major hubs. Yeah, that's what it looks like. So anywhere that you're going to have larger data center presences or population presences, you should probably see larger concentration in those areas. And obviously we can kind of see that in Oregon, Washington, you kind of have the Portland area, and then the Seattle area is heavier, and California, West Coast can be heavier. So it looks like they have a larger fiber presence over on the East Coast, but yeah, kind of interesting things to note. Now, I'm guessing without even like looking into this that they're probably going to see probably a decline or slowing in the leasing on towers and an increase in small cell as we migrate over to more 5G infrastructure, and especially 5G high band for that density. So cities are going to have a lot more small cells than towers for 5G, just because of the density and the higher band that they use, and the basically the increased throughput they need, and the kind of better or worse reception of those bands. They don't really penetrate walls and stuff like that, but the throughput is so good that they're able to offer things like mobile internet service. So it looks like they're trying to drive more organic growth, 40,000 well-located towers, 85,000 route miles of high-capacity fiber, allocate capital to creative. So it looks like they're targeting growth of about 7 to 8% per share, dividend per share growth, which is kind of interesting because they're we'll look further in the financials, but their dividend payout ratio is pretty aggressive right now. And then here they have what they believe is a balanced approach to capital allocation. So we have their breakdown of fiber acquisitions, tower acquisitions, fiber capex, tower capex, because I don't see small cell in here. And I would think that would be a very, very big part of their capital allocation strategy. Yeah, that's kind of strange. And then, yeah, they point out the kind of tailwinds that are happening in the mobile sector with mobile data growth, especially with the 5G build out and deployments. And yeah, we can see that expected, we should have tailwinds into this industry for towers and small cells specifically. Towers maybe a little bit, but I think, see, the problem with so when we look at 5G, most anything that's probably going to be on a tower is going to be lower band on the 5G spectrum, and they're going to actually have better capacity for outreach. So the tower demand might actually go down, I think, in 5G, but small cells is going to, like, especially as they build out those high capacity areas. So there'll be a lot of tailwinds in the industry for this, but it's just a question of, are they going to be able to take up a decent amount of that demand, or is their competition going to? Yeah, and look, they basically agree with me. So towers, small cells, they're just kind of reiterating what I was just saying. Yeah, streetlights, utility poles, small cells. Yeah, that's what they are. So, all right, and then here they get into their debt maturity over the next 5-6 years or so. So, looks like they got what I'm guessing that's 0.8 billion. Yeah, billion, and then 1 point in 2024, 1.3 in 2025, 2.7 in 2026, 4.7 2027. So they got a big stack in 2027 coming up. Weighted average coupon 3.8%, average life 5.4. 68% fixed and 53% unsecured. So they have a big variable debt maturity coming due in 2027. We'll see if interest rates are back down by that time or not. We'll see. And if we can actually, let's keep in mind this debt maturity schedule, and let's go over to their operating cash flow. Let's go over here and we can kind of see operating cash flow is about anywhere from 600 mil to 850 mil average, probably, with kind of fluctuations here and there. Jumping over to the income statement, we can see the operating income growth over the last 10 years. Pretty solid. It's been, there's a cliff in 2019 and then kind of a recovery. They did some acquisitions, and that might have been during one of those I think it was T-Mobile, AT&T, Verizon tower acquisitions. We could look into that further if we want. See, EPS diluted has been pretty steadily growing. So that's nice to see. Weighted average shares outstanding diluted has increased slightly. Depreciation and amortization has increased decently. Operating expenses increased a decent amounts. Balance sheet, long-term debt is pretty significant. So 27.3 billion about. Capital lease obligations fairly low, or a bit lower, about 6 billion. Not about what, 10? Is that 10 billion in goodwill? So decent amount of goodwill from those previous acquisitions, tower acquisitions. Jump over to the free cash flow statement. We can see operating cash flow, like we looked at before, increasing nicely. Free cash flow, decent upwards trend over the long term. Stock-based compensation, not too crazy, nothing too insane. Most of their cash flow is going back to debt repayment and dividends paid. Now, if we go over to the metrics, we can kind of see a little bit more details into their operating cash flow, dividends, net income, leverage ratios, and whatnot. So we can see, and this is kind of what concerned me a little bit, was that their operating cash flow is kind of stagnated a little bit. I mean, really looking from like 2018 to current, it's up a little bit, but it's not like growing a ton. But during that time, they continued to raise their dividend pretty aggressively, and now their dividend payout ratio is pretty dang high. I don't know. That's just a little concerning for me. We can see that their dividend payout ratio was at about 70, 80%, probably 70 low, 80% high, and then it recently got up to about 90%, and that's dividend ratio to operating cash flow per share, or operating cash flow. On a net income basis, their dividends are like way higher than their net income, obviously, but we don't really care about that because it's a REIT. But even a comparison to their operating cash flow, the dividend payout ratio is pretty dang high. And what does that mean? Well, it means that they might be in jeopardy of having to cut their dividend eventually, if they cannot increase operating cash flow to be able to cover their dividend in the long term. Yeah, so I don't know. I don't know if I agree with how aggressively they've raised the dividend over the last several years. They raised it like pretty decent percentage amounts, and they could have kept it a little bit more tame in comparison to their operating cash flow. This might be one of those where management or the company made, just, in my opinion, if they did this, the wrong decision to increase the dividend just for the sake of dividend growth versus keeping their payout ratio in check and steadily increasing the dividend without it being at risk of eventually having to be cut. So that's a little concerning to me. Let's look at their leverage ratios. We can see their operating cash flow to total debt skyrocketed over the last 4 years or so, and their operating cash flow probably really hasn't increased at the same rate. Interest expenses, it's been growing pretty steadily. So interest expenses to operating cash flow ratio, so 24.29%. So about 25% of their operating cash flow is taken up by interest expenses. That's not the best. And then 10% cash flow coverage ratio, 10%. So about their total debt, total debt's 10%. So that probably means that their cash flow is right around 2.7 billion? Yeah, 2.8 billion operating cash flow to 2.79 billion in debt. So real quick, let's plug in AMT real quick and see what their leverage ratios are, because I'm just curious. So it looks like AMT has kind of had this similar like flattening in operating cash flow over the last 4 years. They have been growing that dividend a bit, but still within probably a reasonable ratio. It's about 71% dividend to operating cash flow ratio. And AMT is 90% now. So AMT has a lot more, optionality to sustain that dividend without having to cut it. And it almost looks like, AMT it looks like they do quarterly increases. So maybe a little bit more steady, but then they looks like they might have cut back on doing increases, 156, 156, 157. So it looks like they might be a little bit more stingent on when they actually increase that dividend and making sure that they're going to be able to increase it, that they're going to be able to maintain it whenever they do an increase. Interest expense ratio for AMT, man, has shot up crazy in the last year or so. So their leverage ratio doesn't look that great. And their cash flow coverage ratios look pretty as well. So that's interesting. Wow. Leverage looks worse on AMT, which I was not expecting because AMT is kind of like the golden child in this area. So unless the last couple quarters of data that I have is wrong, which could be, off of a brief glance, CCI actually looks like they might have a better leverage profile, but a worse payout ratio. So AMT's payout ratio could be more stable at its current rate than CCI, but AMT could also, or basically is leveraged up more and might have a little bit more risk with the leverage that they have. So let's go back to CCI. All right, so while CCI did kind of lower their 2023 outlook or guidance, year over year on the quarter, let's see, site rental renewals is up 10%, net income is up 8%, EBITDA, don't really care, up 10%, AFFO and AFFO per share is up 14%. So year over year, they're seeing some decent increases, at least for this last quarter. But yeah, lowering guidance, market usually doesn't like that. All right, and then on the guidance side, it looks like they're targeting about 5% tower organic growth and double-digit annual revenue growth in small cell business. And then they translate that into basically dividend growth target of 7 to 8%. I don't know why giving a target dividend growth, like just give me a target AFFO growth or FFO growth, and then, increase the dividend accordingly. I don't know. They might be trying to appeal to dividend investors way too much. That's the feeling I get. They increase their dividend drastically while their operating cash flow wasn't really growing that much, and then they kind of ruined their dividend ratio, and now they're trying to grow at this 5%, maybe what would that be? Maybe 5, 6%, 7% overall, and pass that down to dividend growth of 7 to 8%, when they're already at a 90% payout ratio for dividends to operating cash flow. So I don't know. I would say if something goes wrong, watch out for that dividend, because that thing will probably be the first to get cut. Because they don't have to pay that much at all, even being a REIT, right? Their net income is way lower than their operating income. So if they have to tighten up, then yeah, watch out for that dividend. Could be in jeopardy. So let's go ahead and we're going to get over to the evaluation. We're getting to the REIT template, and let's just take a look at what they've done previously. So previously, operating cash flow growth has been right at that 7% over the last 5 years. So that's probably what I'm going to use for a base case going forward, is that 7% range. We can see that their operating cash flow per share and dividend ratio, they have had growth on a per share basis, but that dividend ratio, as we've said before, is getting worse and worse. It's at about 90% payout right now. But the dilution that they've been doing has been accretive, but they've been taking on a lot more debt for that as well, that increased operating income. They've been leveraging up more. If we look at bottom line yields, you can kind of see the operating cash flow yield has ranged really between probably 6.25, 6.4% down to the best case of 3%. But really, I mean, that could be an anomaly. And, you know, the previous best was right around 4.5%. So we might use that or look at that range for our valuation. All right, so getting into the valuation, we've got dilution expectations of 0.67% in scenario 1 to 1.02% in scenario 2. I redid the scenarios a little bit, and instead of saying like the different cases. Scenario 3, I'm just doing basically the base case, and that's what I believe is the most probable of happening, and I give that a 50% weighting or 50% probability of happening. And then my scenario 1 case is low probability 10%. That'd be like a more bearish case. Scenario 2 is 20%, and then we have scenario 4 of outperformance and scenario 5 of outperformance. So we're just kind of getting a spread of the different scenarios. So scenario 1, we have a bottom line fair value yield of 7.94%. So it would be valued pretty much up at this 8%. So almost like we're going to lose even more on the multiple. Scenario 2, we got 6.82%. Operating cash flow yield, we're doing operating cash flow only. Scenario 3, 5.9. 5.9 would be right in here. So pretty much at the previous level. Let's see. And then 5.5 to 4.52 on the other two. And 4.52 would be basically right here, something like that. Pretty much at that previous kind of level right before 2020. So that's kind of the spread that I'm giving as far as the 5-year multiple. We're looking at bottom line growth, which is really just operating cash flow growth of the base case of 7%, best case scenario 10.2%, worst case scenario 4.84%. I feel really good with those scenario spreads. And based off of that, I've got a 14% target rate, and that's plus another 6% in dividend. So like that'd be like a 20% target rate. That's pretty crazy. Yeah, I don't know. That's what I feel comfortable with right now. I think I might lower that a bit. But if we were shooting for that 20% CAGR, we basically have a buy price of scenario 1 of 61, a buy price in scenario 2 of 74, a buy price in scenario 3 of 92-ish. Scenario 4 would be 111. Scenario 5 would be 136. Based off of these assumptions, our 1-year fair value in the bearish scenario would be about $98, 115 in the, not bearish, but scenario 1, 115 in scenario 2, 135 in scenario 3, 157 in scenario 4, and 181 in scenario 5. Our 5-year targets for these scenarios would be, scenario 1 would be 116, which is, hey, it's above that, so about 2.25% CAGR from here. 141 for scenario 2, 171 for that base case, essentially, 209 for the scenario 4, and 257 for scenario 5. And that would give us a spread of kind of target rates across these different scenarios, from the current price of anywhere from 2.25% CAGR in the scenario 1 to 19.88% scenario CAGR in scenario 5. Yeah, it's kind of interesting, and that this CAGR right here does not include that dividend. So our target for just stock price appreciation is 14%, but you'd be getting a 6% dividend on top of that on your original capital. If we did change that target rate to something more reasonable, like we wanted a total target of like 15%, like a 7.5 and 2.5, we're basically in the buy zone for the base case right now, or the scenario 3 case right now. And then let's see, scenario 2 would be like a $90 buy. It's pretty interesting. 7.5, 1.5. Yeah, it's getting intriguing. So we'll see what happens. Hope you guys enjoy the video. It's good to be back. I'm going to try to start pumping out more videos. Hope you guys have had a great week, and we'll talk to you later. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube ever.